We need your support. Click the like buttons below. Now onto the video. Welcome to readtheticker.com. Today we're going to review momentum structural analysis. Now this is terminology used by Michael Oliver on his website. He's got a definition of what goes on here. He's got some sample reports. You can subscribe for $1,800 US. It's got a pretty good reputation. But we're going to do a light version of this and look at the Dow Jones. Now, the first thing I want to highlight is that momentum structural analysis is very useful with Richard Wyckoff logic. Why? Because it's looking at long-term moving averages relative to price action. And we are interested in long-term moving averages and price action because it helps when momentum is moving away from the moving average or moving towards the moving average. And this helps with a breakout, the sign of strength or sign of weakness, okay, and also helps with the markup and markdown process. So the momentum structural analysis does add value when you want to consider Richard Wyckoff analysis or any type of analysis, even Elliott wave or Gann or what have you. Now the first thing to understand about momentum structural analysis, is that every price and at any time frame has a relationship with moving averages. Some moving averages fit better and some moving averages don't. Right, so now we're going to look at the Dow Jones monthly chart. Now, first of all, momentum structural analysis is really a redefining of the indicator detrending price oscillator, or in our terminology, DPO. So that simply is you have a moving average. I'll go down here, and here's my move. I've got a couple of moving averages here, pre-chosen because I know these moving averages are important to the Dow Jones. I've got the red one, which is a 36-month moving average, and the blue one, which is a 24-month moving average. Now I know these moving averages are important to the Dow Jones over the last couple hundred years, so that's why I'm using them. So I've done my analysis before this video to work out these moving averages are critical at turning points. Now what we do is we take the moving average and then we measure a percentage move away from the moving average, and then you get your detrending price oscillator. So here we have a DPO, detrending price oscillator, with a move based on the 36 moving average. So this is a 36 moving average, which happens to be the red line. So this point here to that point there is a percentage move, and it is reflected up here, so it's about 20% away from the moving averages. And down below here we have the detrending price oscillator with the 24 SMA monthly moving average as a comparison. So that's the technical out of the way, explaining what's going on. Right, so the first thing I want to note, here we have 2000, 2007, and we're looking at 2020 now, which of course is a 7-year type, span. 27, we missed through 14, and now we're at 2021. So it's a 7-year type of cycle going on here. So what we're looking at a critical juncture of when things change. Now we'll go down to the 24 because that's the faster time frame. As you can see here, the 24 moving average happens to be the blue one, okay? And this is when we got a break here. This was the last test of the 24 as a breakthrough and fell. Broke through and fell. Tested and tested and recovered. We had a recovery here, but didn't really sort of recovered quite well here. You see that? But guess where we are right now? Look at that. We're exactly the same place as we were in 2000 and around about 2000, probably late 2000, October-ish. And we are exactly the same place we were in early 2009. Okay, 2008, sorry. So the Dow Jones is at a critical juncture based on the 24 detrending price oscillator. So it's got a big, quite frankly, to make a big recovery here, it's really got to get back up to 30,000 pretty damn sharply. I'm looking at the 24 because I know the 24 is a quicker signal than the 36. The 36 is a bit more forgiving, right? But quite frankly, the 24 shows us here how critical it is. So we've had two times in the past when the 24 SMA was busted, or the detrending price oscillator showed a critical test, that weakness came afterwards. So at the moment the Dow Jones is at a real critical time. So how can the market go up? Well, we know what happened here. We know there was about $6.5 trillion printed to get the Dow Jones from this point here all the way up to there. And we know this was from the COVID-19 shock of lockdowns and what have you, and that just shut everything down. So that was a typical response. So let's think about big boys and their trading, the whale accounts. Well, they were going long here because everything was long and no one's going to stop them. And this sharp, sudden move was pretty much not hedged for and pretty much not prepared for with shorts. So now we've had a massive $6.5 trillion bounce by the Fed in measure. I'm talking about Fed balance sheet accounts. I'm talking about the Treasury account. I'm talking about excess reserves. Talking about swap lines. Have all pumped this up. So what does this bounce do? Well, it pretty much takes the Dow back up to near previous levels. So one, the big players out there in the hedge funds, in the institutions they can hedge the position if it's going to go down again, or they can build up massive shorts. Right? If the market ever wants to trade with fundamentals, right? As we all know that fundamentals have been distorted. We've had situation where we've had flat profits and rising price, and the share buybacks has lowered the number of shares outstanding, and therefore because the earnings have been flat and the shares have fallen, that means the earnings per share have gone up. But now we've got a situation where the earnings are falling, right, faster than the shares outstanding. So that means the EPS is going to come down, or they're going to buy back a huge amount of shares. So the next couple of months, I think the next month we've got the earnings reports coming out, and they're going to be pretty bad. So obviously we're going to get overestimations of future EPS. We've got to get overestimations of economic data, and it's going to probably take a couple of months before a realisation of where we truly are. Now, I want to offset that point of the fundamentals with the dollar. If the dollar can go down 10-15%, you'll see the Dow probably hold its position. But that's going to be very interesting to watch for the dollar to go down, because the offset to the dollar going down with a massive money printing is the fact that the European banks are putting a lot of money into dollars to offset the risks of a crash over there, because the European banks are not looking good with their negative interest rates. Okay, so that's both sides of the argument. So the moral of the story is 24 SMA and the 36 SMA is important, with the D-trending price oscillator with the same settings, and we need a couple more months to see which way this thing's going to go. Now I just want to highlight that the Dow and what happened in 1929, because apparently that's comparative. Here we have your 1929 situation, straight up, straight up, straight up, and obviously we had a big smash similar to the COVID and a recovery, and there's a few commentators out there, Gary Schilling, I think Roel Powell, and a few others are saying, well, we could be in a situation where we might see a bit of a downside, another 30-40% drop. And I've got the 24 and the 36 M&A here. As you can see, quite frankly, the 24 is giving pretty much the same signal as we're getting right now. See? The same signal as 2008, early 2008, and around about there, which was late 2000, probably 2001, because it's a two-year difference. Okay, so we are at a critical juncture in the Dow. It's going to be very interesting to see what rolls out. It is on the table. There could we get a test of the lows in the Richard Wyckoff terms. I would like to see some sort of test of a low to be positive. I wouldn't want to, if it was going to be bearish, it would go down 22,000, but obviously a test of 24,000 and hold, build up a little pattern, and show that the market was overcoming the fundamentals and we could go up here. Because at the moment, what we have here in Wyckoff terms is we have a big move up. This is a massive change in momentum, state the obvious. So all up here was people were selling here. This is what they call preliminary supply. So people were enjoying massive profits and said, look how much profit I've got. I better take some of those gains, and they made some sales here, right? And they're continuing on very cautiously. And quite frankly, this is the shock that's really blown everybody out. So nobody was hedged here as much as they should have been, and nobody was short as much as they should have been. But this bounce has allowed that. So if a market goes down 20-30%, the damage is going to be, well, it's going to be huge, but it's going to be on these portfolios. The manager's going to be more prepared. Just like what happened in 1929, the 24 SMA gives us a quicker warning than the 36 SMA on the detrending price oscillator. So if you're a long-term investor out there and looking at portfolio, be very careful the next 2 months. Thanks very much for watching.